Hi, good morning, everyone. It's Debbie Haning with Coldwell Banker. I am here on December 19th with Craig White from Cherry Creek Lending. And we thought we would just hop on there and answer some of the biggest questions that I'm getting from all of you. So, Craig, thank you for joining me today.
You're welcome. Thanks for having me.
I've written down a couple questions, and so if you don't mind, let's just get started.
Yeah, let's do that.
So what I'd like to start off with is talking about today's interest rates versus where we were from before COVID. Why did these changes happen? Can you talk about all that a little bit?
Sure. Well, pre-COVID, as we all know, we were in the lowest interest rate environment we've seen in our lifetimes at about 3.5%. That's February 2020 is when we were sitting around there. Since then, we've peaked out at November at nearly 7%, and that was with some points as well. And that was November 10th that it kind of peaked out. Since then, we've seen it fall a little bit more. So now we're sitting in the lower sixes with some points as well, depending on your situation, obviously credit scores and things of that nature. But we do seem to see that the peak has happened, it looks like, in November. But we don't really ever see that till it's in our rearview mirror. And what we anticipate going forward is to see interest rates probably fall into the mid fives or lower fives by end of first quarter, beginning of second quarter next year. That's where most of the experts are kind of pinning it. The ones that I follow, as well as the charts and everything, seem to say that that's where interest rates would be at a good spot for the market overall. I don't think we'll ever get back to where we were in pre-COVID at the 3.5% interest rates on 30-year fixed. I think that's something that was just a perfect storm of things happening with COVID and fiscal and monetary policy, which I won't get too far into. Yeah, I don't know that we'll see it. The most comfortable range looks to be in the mid fives, and we seem to be heading towards that mid next year.
So you don't see a big drop coming up. There's no reason, buyers should wait, maybe get started early. And so when they're ready, they can enjoy that, what we hope to be a better rate.
Sure. Well, the advice that I'm giving all our buyers right now is to buy now. A little phrase that's kind of popular in the market is to marry the house and date the rate, meaning that where you're going to have the opportunity to refinance the rate down the road. Like I said, when we hit those mid fives. In the midterm, we're seeing a lot of things like buy downs, which are helping out the market. A buy down is a situation in which a buyer will get a lower interest rate for the first full year and a second full year as well, generally 1% off each year of the interest rates. And that can save them hundreds of dollars a month over where interest rates are now. And the good thing about that is then 2 years from now, they can refinance that to get back into that mid-level 5 rate we've talked about.
Can you talk about that buy down a little bit more? I know there's a 2-1 buy down, and then is there any other methods that can help people trying to get into this market right now?
Sure. There's other buy downs. There's 3-2-1, 2-1, and 1-0 buy downs. Depending on your loan program, it depends on how much of one you can do. But what the 3-2-1 buy down, for example, is that you get 3% off your interest rate the first year, 2% the second year, and 1% the third year. So if you were looking at a mid-6 interest rate to start, you really could be paying a 3.5% interest rate. And what that can do is for a seller, what it can do is instead of the seller having to reduce their price by $25,000, they can offer this as an incentive, and it can lower the price it'll lower the payment for the buyer and therefore create a bigger buyer pool. It has a greater impact than that $25,000 reduction just straight on price, because that only really saves the buyer maybe $50 to $70 a month versus this saving hundreds and up to $1,000 a month to get started, which is really what the market needs. And the benefit of it as well is that the buyer right now has the opportunity to buy at a little bit lower prices, since we've seen those interest rates go up and the market to slow down a little bit. So that's what the marry the house is all about, is get it now while you can get the deal, get the interest rate figured out later down the road. But in the temporary or in the in between, you can use the buy down to have that lower payment still to where you're going to be maybe down the road as well.
What can buyers do right now to achieve their goal of home, purchasing a new home? How do you suggest they prepare so that when the time comes, they're ready?
Well, the first thing is, just educating themselves and getting with a lender to get pre-approved, or at least to look at their situation and see what's best for them coming up, whether it is a job, if there's a job situation or a credit situation that needs to be fixed. It's better to know that up front, and therefore you can start to address it. Once you're qualified and have a buyer, have a pre-approval in hand, well, then it's just a matter of going out and negotiating with what's going on in the market right now. And I think now's the best time to negotiate. If people are going to, if they sit on the fence and wait for those interest rates to come down, like I said, in 6 months, they'll end up competing in a market that we were in before, where there are going to be multiple offers, and they might have to pay more than list price for the house in order to get it, where now they might be able to get that reduced price that we talked about with the buy down as well.
So a couple of things I took from what you said: in addition to meeting with the lender to get pre-approved, you can also find out how much you can afford. So you're not looking at a house and then later you find out that, the payments are going to be higher than you want.
Yes.
So I think that's good. And then as a realtor, when I'm submitting an offer and I have a pre-approval letter, which means that you have gone through and you have approved, you've checked everything. And when I'm giving that to a listing agent, I think they're more comfortable with that, than just like, we think they're pre-qualified. We're really not sure, but it looks like they can afford the house.
Right. Well, it is. I mean, a full-blown pre-approval, which is what we do, is your best option. I mean, one, it's going to give you a strong position with the seller when you're trying to negotiate. Secondarily, yes, it tells you where you sit. So when you go into that house, whether or not you can afford it and what your price is going to be, and whether that's the top end or the middle or the end, because different things like HOA dues, taxes on newer build properties, and things like that can impact your payment by hundreds of dollars. So you want to be fully educated up front about those items before you go out looking, so you're not shocked and you don't have sticker shock essentially once we talk about it. And plus, where interest rates are now is a little bit different on payments as to what they might have seen in the past.
We certainly don't want to be shocked. We don't want those surprises.
Sure.
So one big question, and there seems to be a lot of confusion, and I know this is something you could get into for a half an hour, but briefly, when the feds changed their rates, is that the same as the mortgage rate? People seem to be confused and think that if the Fed raises their rate, that automatically raises the mortgage rate.
Yes, and as we saw, the Fed did just raise their target interest rate by 0.5% on Wednesday. So they're at 4.375. What that is that's the rate in which banks lend each other overnight. And that's really a short-term monitor on interest rates. So no, it doesn't have a direct impact on interest rates. We didn't see a 0.5% increase in interest rates. As a matter of fact, interest rates tend to fall, and that's what the whole purpose of this raising of the interest rate is they're trying to curb inflation, which inflation is the arch enemy of interest rates. And that's why we saw interest rates rise so quickly, is because of inflation. And now that they've adjusted this interest rate higher, we're starting to see it come down a little bit. The inflation numbers have been less for the last few months, and we'll continue to see that. So it has a correlation to interest rates, but really that's the short-term interest rates. Mortgage rates are on their own 30 long-term interest rate market, which doesn't directly change with the Fed rate.
That's good. That's good. And one final question, which everybody seems to wonder: are we in a bubble?
No, we are not in a bubble by any means. What we see is, we've seen deceleration of housing values, which, that's like going 75 miles an hour, which we were doing, or near 100 miles an hour as far as our appreciation goes, slowing down to 55 miles an hour or something of that nature. You're still going forward. You're still earning valuation on the home. It's just not as rapidly. Previously, it was up in the 14 to 15% range. It slid back to 10% year over year now. So we've seen that kind of deceleration, but we're not seeing negative home
Certainly not a
prices.
bubble.
And
No.
no, not a bubble. Some of the adjustments you saw too were prices were overpriced and people were still waiting to see if they couldn't get that high price. And those prices had to be adjusted because interest rates went up so quickly that the buyer market shrunk. And so, we saw some, like I said, slow down in the prices. But you know what? I think when you look back on it, it's going to be a little dip in a valley. Housing prices are going to continue to increase from here going forward.
Yeah, I think you're right. Well, unless there's something you'd like to add, that was kind of all the questions I had.
I think that's pretty much it. Like I said, as of right now, if I was a buyer, I wouldn't be sitting on the fence. I'd get out there and get buying right now before the market changes again, so we can get them a good deal, and they'll be able to have a sufficient payment later.
Right. Well, thank you very much. We are going to drop your contact information in for everyone to see, and I appreciate you joining me today. So have a great rest of the week and happy holidays.
As well, thank you for your time. Happy holidays. Thanks, everyone.
All right.